Hey guys, welcome back. Today we are going to solve one problem from cost accounting EVA chapter, and this problem is from management accounting EVA chapter. This problem is from June 24 attempt, right? June 24 attempt. Okay, so let me give a little intro about the EVA and directly we'll proceed with the problem. Okay, what does it mean by EVA? EVA is the economic value added. Economic value added means how much wealth has been created by the company for its shareholders. Company wealth to its shareholders, okay, beyond cost of capital. Okay, so how much beyond cost after paying the cost of capital? If there is any balance of profit, that is EVA. Okay, so EVA formula is no PAT, which is after paying the tax, whatever the profit we have, which is the no PAT minus capital employed, how much capital we have in our balance sheet, right? So okay, capital employed into weighted average cost of capital, how much we have to pay as a capital, okay, as a cost of capital, that is weighted average capital. Okay, these are all the three things which will become as our steps. If we find out all these three, that's it, the problem is over. Okay, what does it mean by what does it mean by EVA? EVA is the method to know whether the profit has whether the wealth has been created or not. If there is a positive EVA, if there is a positive balance of EVA, then wealth has been generated. Okay, wealth has been created. If there is a negative EVA, wealth has been destroyed. Shareholders' wealth has been destroyed. That's it. Okay, EVA, whether profit is good, okay, positive balance of EVA is good, negative balance of EVA is bad. No PAT means net profit after tax. Net profit after tax, we have a operating profit. No, operating profit is what we have our contribution after removing the fixed cost, we get the operating profit. Once we got the operating profit, from that we reduce the tax portion. Once we reduce the tax portion, we got the net operating profit after tax, right? So okay, net operating profit after tax. What's the capital employed? Here you can see that capital employed is equity share capital, reserves and surplus, 12 percentage point. Okay, even you can say that reserves and surplus is not capital. Reserves and surplus is capital belongs to the shareholders only. We have just retained it. That's it. That's a retained earnings of shareholders. Okay, so reserves and surplus is the retained earnings of shareholders. This is the capital employed only. Reserves and surplus is not savings. This is the retained earnings of shareholders. Okay, we have to pay to shareholders, but we have retained it. That's it. Okay, reserves and surplus. Okay, reserves and surplus also part of capital employed, right? What does it mean by weighted average cost of capital? Weighted average cost of capital is they said the debt equity portion is 1:4. We have to find out what's the cost of capital of debt and what's of the cost of capital of equity, and we have to weight it. We have to weight based on 1/5, 4/5. We get the weighted average cost of capital. That's it. Okay, let's quickly jump into the problem. First step, we need to find out the no PAT. How can we calculate the no PAT? Here, there is no direct information for us. Before that, we'll quickly read the question. The summarized balance sheet of Messrs. Sova Limited has done 31/3/2024 has been given. Okay, they have given the balance sheet. Balance sheet items are equity share capital, reserves and plus surplus, 12% bond. These three items only required for us. Other than that, we don't require this balance sheet. Okay, Messrs. Sova Limited is engaged in manufacturing electrical transformers. Okay, the sales and cost details for the year has been given. Okay, they have given the sales price per unit, PV ratio, MOS ratio, fixed cost per annum, tax rate, risk-free rate of return, market rate of return, beta factor. Beta factor is the company risk. Okay, if the shareholder has to invest in a company, apart from the safe bonds, which is actually generating the 8% rate of return. What's the risk rate? So the risk rate is 1.1. So and the debt equity ratio is 1:4. So we got all the values, but we don't have the direct values, right? So how can we compute that? First, We know the BEP formula. BEP formula is fixed cost per annum divisible by PV ratio. So we can calculate the BEP. First, we'll try to finish off the. Okay, before that, I'll tell you one thing, which is BEP is the fixed cost coverage, right? Fixed cost coverage, right? After BEP, at this point, after BEP, we have a profit portion, which is MOS. Okay, so this is profit. So have this in our mind. This is no profit, no loss area. No profit and loss. Okay, right? Okay, so have this picture in your mind. We'll quickly finish off this problem in no time. Okay, so okay, BEP is equal to fixed cost divisible by what's that? PV ratio. Okay, what's the fixed cost? Fixed cost is 25 lakhs. What's the PV ratio? PV ratio is 20%. Okay, PV ratio is 20%. Okay, 25 lakhs divisible by 20%, which is 1 crore 25 lakhs. 1 crore 25 lakhs is the BEP. If we calculate with the PV ratio, we get the value. Okay, value. This is not per units, this is value. Okay, right? We got the BEP value. We got the BEP value. We can, with this BEP value, we can find out the total sales. How? Total sales is equal to, we got the BEP value, right? So BEP divisible by what's the BEP percentage out of total sales that we have here. See, we have given you the MOS ratio. MOS ratio is 60%. So 1 minus MOS ratio is BEP ratio, right? So BEP is 1 crore 25 lakhs divisible by 1 minus MOS is how much? 60%, which is actually 40%. So 1 crore 25 lakhs divisible by 40% is 3 lakh 12,000 50,000 3 crore 12 lakh 50,000, right? We got 3 crore 12 lakh 50,000 as total sales. Okay, we got the total sales also. Then what we have to calculate is the contribution per unit. Sorry, total contribution. How can we calculate the total contribution? Total sales into PV ratio, right? PV ratio constitutes to contribution. Okay, 3 crore 12 lakh 50,000 into PV ratio is how much? PV ratio is 20%. So we got 20% as contribution. 3 crore 12 lakh 50,000 into 25%, which is 78 lakh 12,500. Okay, wait, 3 lakh 12,000 50,000. So 3 crore 12 lakh 50,000 into 20%, which is, sorry, this is actually 62 lakh 50,000, right guys? 62 lakh 50,000, calculation mistake. Okay, we got the total contribution. What else we have? What else we want? Just we need operating profit. Okay, total contribution we have calculated minus what we have to do is fixed cost. We get the total. We get the operating profit. How much is the total contribution? 62 lakh 50,000. What's the fixed cost? Fixed cost is 25 lakhs, right? Yes, 25 lakhs. Rupees 37 lakh 50,000 is the operating profit. So guys, we got the operating profit, and we'll quickly get the NOPAT also. NOPAT is what? Removing the tax savings. Sorry, removing the tax payable. Okay, 37 lakh 50,000 into 1 minus T. T is what? 30%. 1 minus 30%, which is 37 lakh 50,000 into 30%, which is 26 lakh 25,000 is the NOPAT we have calculated. See how we have derived this. We are given with the fixed cost, and okay, with the given data itself, you can find out which formula we can use, and based on that you can move accordingly. Okay, this is not something that we have to go on a way. Based on the formulas, if you are thorough with the marginal costing concept, This NOPAT calculation is simple. What the question has given? Question has given with the fixed cost and PV ratio. We got the BEP. Then what we have done? We know the BEP, but we don't know the BEP percentage. But we know the formula that BEP is equal to 1 minus MOS. Okay, if we do this 1 minus MOS, we get the BEP percentage. See this formula. That's why I have derivatives. After BEP ends, once BEP ends, MOS starts. Okay, so after 40%, 60% they have as a profit. Okay, 60% they have as a profit. So we have calculated 40% is the BEP percentage. Okay, total contribution, we know total contribution, PV ratio, sales. From the sales, if we calculate the if you multiply the PV ratio, we got the contribution per unit. From the contribution per unit, if you remove the fixed cost, you get the operating profit. Operating profit is the total profit. You have to pay the tax for that. After paying the tax portion is 1 minus tax rate. So if you pay the tax out of it, you will have a net operating profit after tax, which is 26,25,000, right? Yes, done. So the first step is done. What's the second step? Second step, we have to find out the capital employed. Capital employed is 25 lakh plus 15 lakh plus 10 lakh, which is 50 lakhs is the capital employed. Okay, the third step is weighted average cost of capital. Okay, weighted average cost of capital, we have two, which is KE, KD. Okay, what's the formula of KE? Okay, KE formula is risk-free rate plus beta into risk market rate of return minus risk-free rate of return. Okay, so what's the risk-free rate of return, which is 8%? Right, 8% is the risk-free rate of return. Beta percentage is how much? Beta percentage is beta factor, which is 1.1, is the actual risk rate of the company. Market rate of return is 17%. 17% minus risk-free rate of return is 8%, right? So 1.1, okay, 17 minus 8 into 1.1 plus 8%, which is 17.9 is the cost of capital. Okay, so this is the cost of capital we have to pay to our shareholders. Okay, what's the cost of debt? Debt percentages. Cost of debt is 12%. See, 12% they have given, right? 12%. 1 minus T. We have to remove the tax savings from the cost of capital. What's the tax? Tax is the 30%. 12% into 1 minus 30%, which is 12%. 12 into 70%, which is 8.4%. Okay, we got both. What we have to do is calculate the weighted average cost of capital. What's the portion, or what's the weight of KE? KE's weight is 4. Okay, 17.9% into 4 by 5 plus 8.4% into 1 by 5. So we got it, 17.9 into 4 divisible by 5, which is 14.32% plus 8.4 divisible by 5, which is 1.68%. Total it, we get 14.32 as the weighted average cost of capital, which is 16%. Okay, yes guys, we have got all the figures. Now we can directly plug the figures into the EVA formula. What's the formula of EVA? EVA is the real profit. Okay, what's the real profit? We are going to find out now. What's the what's the formula? What's the formula? EVA is your no PAT minus capital employed into weighted average cost of capital, right? No PAT is the calculation we have done, which is for 26 lakhs 25,000. 26 lakh 25,000. Now what's the capital employed is 50 lakhs into what's the weighted average cost of capital is 16 percentage. Okay, we have to pay 16 percentage 16 percentage 16 percentage interest to the respective investors. Okay, so 26 lakh 25,000 minus 8 lakhs, remove that, we get the 25,000, which is 625,000 minus 625,000 minus 8 lakh, which is 18 lakh 25,000 is the economic value added. So we got the value, which is 18 lakh 25,000. So guys, the thing is, you have to understand the concept and apply it. You have to be thorough with the marginal costing formulas. Then you can easily pick the figures and plug it into the values. Okay, and you have to memorize this formula, which is risk-free rate of return. Okay, what I'll quickly explain this formula. Okay guys, what the investor will say is, if I put it in a safe bonds, I will get the risk-free rate of 8%. Okay, but I am investing in your company. Your company's risk percentage, your company's risk factor is 1.1. Okay, 1.1. Okay, the market rate of return market rate of return is like the companies you are running, the companies in the market are providing 17% return. Okay, if I put in market, I get the 8% return. If I put in any of your peer companies, I will get the 17% return. Your company's risk factor is 1.1%. So what you have to do is, the difference for the difference of safe and market return, you have to find out the company's risk factor. If you multiply that, you will get the figure which is actually addable with the risk-free factor. This is the earnings for the investors who have invested in the current company, understanding the risk factor of 1.1%. So that's it. So the company has to pay 17.9% as the rate of return to the shareholders, right guys? That's it. Very simple formula. The thing is, we have to understand it correctly. That's it. Thank you.